Right. Good day and welcome to another session of tutorials. If you can hear me, please just give me a thumbs up as we begin tonight. You can hear me? Let me know you can. Thank you so much. Well, again tonight we just rush into what we have to look at while others are joining us. Previous classes we have been able to look at quite a number of standard and we have a lot of standard to cover. So we just need to give some speed to whatever it is that we are doing. Now we look at this standard tonight, and that is, I think, the last standard under the non-current asset in the statement of financial position, and that is investment property. We are looking at this straight ahead, and when we say investment property, it's just as the name sounds, investment in property. Investment in property. That's what the name sounds. And for every investment that you are making, you are expected to make a return. But then, in the wisdom of IASB, they have been able to give us definitions of what investment property is, how to recognize it, and how to measure it, as well as the other accounting treatment as it relates to it. And that's what IS 40 is all about. It talks about the definition, the recognition criteria, the measurement, and the disclosures as it were. So, quickly, what is exactly investment property? Like I told you, just as the name sounds, investment property. So, property. Investment property simply means a land or a building or a part of a building or both. That is to say, land or building, part of a building, or both. That is land and building joined together. That is held for capital appreciation or for rental purposes. That is to earn what we call a rental income. So let's break down the definition so as we proceed. Once you get the understanding of it, we can easily forge ahead. So investment property simply means land or building or a part of building or both, that is land or building, that is, or both, or a part of building or a part of land that is held by someone that owns the property or by a lessee under the lease agreement under IFRS 16, and to earn what we call a rental income or for capital appreciation or both. So what this definition is saying is, if for instance you buy a parcel of land and the essence of you keeping the land is you want to keep it for, like, say, let's say for about 5 years, you know that in that 5 years, the amount that you are buying the land is not the same amount that will be sold in the next 5 years. That's what we call investment property. So that property, as it were, you kept it. Let's assume you bought it for 50,000 naira this year, and then you kept it for a purpose that you are not going to use it for anything. You are not going to use it for any business, as it were. You are only keeping the land so that in the next 5 years you weigh the options, you weigh it again, and then to know if it is appreciated or not. So let's assume that you kept the land for 5 years. That 5 years time, just ask people around, how much is the land now around this place, and they tell you it is for 500,000. Remember, you bought it for 50,000, and now 5 years time it is sold for 500,000. That is what we call capital appreciation. So the purpose, the intention is what differentiates property of land and building under IAS 40 summarily from IAS 16. So the intention in terms of usage, in terms of reasons why you are holding it, is what differentiates land and building that is being used under IAS 16 and then investment property under IAS 40. So whenever there is a building or a land that is being held for the purpose of capital appreciation or for rental purposes, that is what we call an investment property. What about building? Building that is, you build a place and then you give it out for rent. That's what we call the rental income. You give it out for rent. People are paying rent to you. That's an investment property. So it's as simple as that. It's not a difficult standard, but if you don't have the basic understanding of it, you can mix it up. Now, why did they say a part of a building also in the definition? You can have a building that you have built, and then you now rent a portion of it out. Let's assume now you build a duplex. You are staying in one of the room up, that is one of the flat up, then down you give it out for rent. Remember, it's a twin duplex, one up, one down. You are staying up, or let's assume two bedroom two flats now, one up, one down. You are staying up, one is staying down, whereas it is a two-in-one building. That portion of building that you are staying cannot be considered as a investment property, whereas the one that you lease out, the one that you rent out, that is the portion that we can call an investment property, because you are renting it out, and then that is that for that. So quickly, let's look at some other aspect of this very important standard. That's talking about the examples, as it were, the examples. So we have quite a number of examples here. We have a property that is being constructed or developed for future use. Let me go up a bit so you can see it better. So a land, that's examples now. A land held for long-term capital appreciation. I've explained that. Building leased out under lease. Vacant land held for undetermined future use but not for sale. That's investment property. Then we have property intended for use in operations. All of these that I'm mentioning now, they are not part of the investment property. Please, 1 minute. Just give me 1 minute. Okay. Thank you. So now, examples of investment property include land or building. And I've mentioned that, so let's not bother ourselves about that. Now, what is not an investment property? I told us when I was giving the definition that the intention matters a lot. Why are you holding the property? Now, a property that you intend to use for operational activity, for instance, as an administrative office, or where you want to be selling your goods and your services, they are not investment properties. That's number one. Those are known as classified as PPEs. The building, the land that you are using in ordinary course of your business, they are not investment property. Property that is developed for sale, like all these estate people now, people that build houses and then they sell it. What they are doing is not investment property. What the building they are building, the houses they are building and selling, or the land they are selling, they are not investment property. They are known as inventory, because that is what they trade. People that are into real estate, that is what they trade. They trade land, they trade building. So what that thing that they are trading, the land and the building are trading, they are known as their inventories. And then we also have the owners occupier. That is a portion of a property that is being used in ordinary course of a business, that is well. And then you have property that is held for short-term resale. For instance, you buy it in January and you are selling it in October. That cannot be classified as an investment property. For you to call it an investment property, it means that you are holding it for the purpose. The intention is that you are holding it for you to either earn rent, that is above 1 year, 1 year and above, or you are leaving it for a particular period of time for the capital, the value to appreciate, as it were. So please take note of that. That is under the example. So quickly, I told us whenever we are looking at standard, we just do the overview, and then we move to the recognition and the measurement and the disclosure. Those are the 4 key things that you must know about any standard that we are looking at. So, recognition criteria. An investment property shall be recognized as an asset when it is probable that the future economic benefit will flow to the entity. Now, let me also say this clearly. Whenever we are looking at standards, you don't need to cram it. Once they say recognition, For instance, under assets, the recognition, majorly the two things you must know. If you like, just keep it, just say PC, PC. P stands for probability, C stands for cost. So for you to recognize whatsoever that is called an investment property as an investment property, the probability that it will generate future economic benefit to the owner, that's when we say anything to the owner, must be high. It must be probable, it must be more than 50%. That, and then number two, the cost of the property must be reliably measured. The cost of the property must be reliably measured. In other words, the value or the amount that will be attached to the investment property, you must be able to calculate it. That is how simple it is. So recognition criteria, they are just basically two. Probability of a future economic benefit accruing to the owner or the entity. The cost of the property are, reliably measured. It's as simple as that. Now, understand this, that investment property and property, plant and equipment treated under AS 16, they have almost or similar process of measurement. Now we are moving to measurement. We have dealt with recognition. I don't want us to dwell much on this standard because it's very simple, and just listen to what I'm saying, you will grab it. You understand now? So we have measurement. We also have under measurement, we have initial measurement, and we have subsequent measurement. So who can quickly tell me how to carry out initial measurement? Who can quickly tell me how to carry out an initial measurement? Can anyone try? Under IS 16, use the wisdom of IS 16 and let me know. Are you here? Okay. Go ahead, Moses. Moses, go ahead.
Good evening, sir.
Good evening,
I think the initial measurement is measured at cost.
Okay. So tell us what are the costs? What are the costs?
The total cost of the asset.
Yes. What is the total cost? How do you measure the total cost? How do you measure the total cost?
The cost of the assets plus all the attributable costs of bringing the asset into its intended use.
Okay, thank you so much.
The total cost.
Now, don't use cost now. Use what we call the net purchase price. Remember, I told you the purchase price plus other directly attributable costs. Thank you, Moses. You have done well. And for that, I'm giving you 2 marks. Thank you for the attempt. It's a wonderful one. So, the initial
Thank you, sir.
Thank you, too. The initial measurement is just as he has explained. Please note that. This thing should be in your head now. It will be in your head. Under measurement of any assets, of any non-current asset, any item that is under non-current asset, as long as they are tangible. The initial measurement, as long as they are tangible, the 2 measurements are initial measurement and subsequent measurement. And I explained to us the last time that the initial measurement is for, the first time costing of the item, the first time cost that you are going to attach to the item. While the subsequent measurement is what we call the current cost. After a year of usage of an asset, you don't expect that the value will be the same thing. Is that not so? After you have used it, the value for next year will not be the same thing as of this year. And that's why it is not all right that you should carry the value of your asset this year as the same way you will carry it the subsequent year. That's why we call it subsequent measurement. You have measured it for the current year, you have attached the value to it. What then is the value in the subsequent years when you are using it? That's what we call subsequent measurement. So quickly, we have been able to give a definition to all of this. We just run through it and move ahead. So investment property is measured initially at purchase price plus directly attributable costs, professional fees, legal fee, property transfer taxes, all of such directly attributable cost. This cost does not include the following. Remember, I told you directly attributable cost. But any other cost that is not directly attributable, they are not considered. And what are those other costs? So like startup costs, all these operating losses before property achieve the plan of occupancy, all those operating losses that you may analyze, they are not part of it. Abnormal waste during the construction, all those abnormal waste during construction, they are not part of it. Please take note of that. Only the costs that are directly attributable is what we had of the purchase price. A good example is when you buy land, you buy the land, let's assume 1,000 square meter, and then you now fence the land. Remember, you bought the land for 500,000. That 500,000 that you bought the land is the purchase price. Now, the direct attributable cost is the cost of fencing the land. You had it together. Another example is now you bought the land and then you process the paper. You know, all those fee that you pay, legal fee, all those professional fee, local government fee, everything put together, they are what we call directly attributable cost. So you had it together. It sums up the initial cost of the property. Is that taken? So that is that for that. Any question? Whereas we have what we call the subsequent measurement. Any question? I'm sure we are fine. Let's go ahead. We have what we call also the subsequent measurement. Another the subsequent measurement, I told us when we are looking at IS 16 that you can use two model. Who can remind me the two model under IS 16 that we said we can use? Can anyone help us? Are we still together? Can anyone help us? Under the IS 16, we said two model can be used. Okay, go ahead. Who's that? Yes. Go ahead.
Hello.
I can hear you. Please go ahead.
Cost model and evaluation model.
Come again. Thank you.
Cost and evaluation model.
Cost model and revaluation model.
The cost model and then the revaluation model. Under the revaluation model, we have
model and revaluation model.
Thank you. So you can mute your mic, please. Mute your mic. Thank you. All right. So under the revaluation model, I can hear you.
Okay. Sorry, before we go forward, sir, I just want to ask question concerning this abnormal waste. What do you mean by this abnormal waste in the cost that we cannot be assigned to the cost of the asset?
Okay. For instance, now, if you are used to the site, if you go to a site now and they will tell you that let's assume that they are plastering a building. They are plastering the building, and then you know in the process of plastering now they have mixed cement, stone, and every other thing, and then the rain just starts, and they could not continue the work. And then that whatever it is, cement, everything that they have wasted, is that not an abnormal waste? So those are the type of things we are talking about. Anything that is not normal, what is it? Just as the name sounds, whatever. It's just when you were doing your costing, some of you that are doing costing or that have done costing, for instance, what we call abnormal, what is it called now? Thing have escaped me now. There's what we call abnormal, just like a waste still, abnormal waste during the production process. Abnormal waste during the production process. Yes,
abnormal waste.
Yes, during the production process. So all those ones too is not also
abnormal loss.
Just like a waste. Thank you. I'm sure you understand now.
Okay. Thank you, sir.
Abnormal loss.
Thank you so much. Abnormal loss. Yes, that's abnormal loss. That's the name. Thank you so much. So that is that for that. So under IS 40 also,
yes,
there are two models. that we are using, and we have that is under the subsequent measurement. We have the fair value model and the cost model. We have been able to look at We have been able to look at the fair value that is under IFRS 13. Under IFRS 13. Don't worry, I'm recording, and don't worry about that. So we have the fair value model. We have looked at how to do fair value under IFRS 13 in our previous lectures, and I'm sure you are well grounded. And then we have the cost model. The fair value model is actually what IAS 40 IASB, they are advocating that we should use, because it is more moderate and more effective. And fair value, like I told us, is basically what we call the market value of the property. For instance, now, if you are to use a cost model, it means that you have to be depreciating what is it called? Depreciating the investment property over the useful life of the property. But land you can't depreciate land. Land appreciates. Land does not depreciate. And that is why cost model is not all that applicable under the subsequent measurement of investment property. So it is always advised that we use the fair value model, which is like the market price, the prevailing market price around the property. For instance, now, if you have a house at Ikeja, you bought a building at Ikeja, or you bought a land at Ikeja, you kept the land there for, let's say, for some time. The reasons why you kept it there is you want to leave it so that in the nearest future, you either sell it or you want to know what the worth will be. You understand me now? That kind of land now, let's assume you buy it in 2020. The cost of land as at 2025 right now at Ikeja is higher than when it than 2020. Let's assume when an individual will have bought that kind of land. You understand now? So if you should go there to Ikeja today now, you don't necessarily need to, be doing yourself, all kind of calculations and the likes. All that you need to do is ask around. This my land now. Let's assume it's 1,000 square meter. How much are they selling land around this place now? 1,000 square meter. Let's assume that 2020 you bought it for 500,000. This year 2025, you go there and ask how much are they selling land now. They will tell you. Once they tell you, it's now 200,000. That is how to measure your land. Now you remember, as at 2020 you bought it and every of the cost was 200,000. But now in 2025 they said they are selling it for 500,000. It means that when you are now going to carry your investment property in your book, you are not going to carry it again at 200,000. You are going to carry it at 500,000. And that 500,000 going around and asking the question is what we call the fair value. That is the prevailing market, that you can, the price that you can see around in the market, or that you can see around where you have your business, where you enter to do your business. It's as simple as that. I don't want to use too many grammar. That's why I'm trying to use a layman language for so many of us that, we are not yet there. So just understand it the way I'm putting it. Make it simple. Understand it in your way. You can interpret it in your way. So that is that for that. Any question? Any question? Okay. So if we are clear, just give me a thumbs up so that we can move ahead. There is nothing much in the IAS 40. I just want you to have this basic understanding, and then we move ahead tonight. So quickly, let's go to the recognition. So when we say the recognition of investment property, like I told you, when we are looking at the conceptual framework, the recognition can take place once an asset no longer meet the criteria of recognition. For instance, we said under recognition criteria, it must be highly probable. If the probability that the investment property will not yield future economic benefit to the entity or to the owner, we should derecognize it from our book as investment property. For instance, you held a land or you bought a building and then you kept it, let's say, for 2 years so that you can, get more money on it. But 1 year, 2 months, you discover that you need to use it for an office space. You convert it to an office space. You must derecognize that investment property and now recognize it as under the property, plant, and equipment in IAS 16. So what I'm saying is, once the criteria is no longer met, you derecognize it. You are no longer going to recognize it on the financial statement as investment property. And number two, when you dispose it, once you sell it, it's no longer an investment property. You bought the land, you are carried for 3 years. At the end of 3 years, or in the 3rd year, you sold the land. You sell the land, rather. Once you sell the land, it's no longer an investment property to you. You have already sold it. So that is that for that. So please, whenever there is also a disposal of investment property, you must always recognize the gain and the loss. The gain and the loss, you must recognize. Very, very important. How do you recognize the gain? It's like the amount less the current amount. Once the proceeds, the sales proceeds is higher than the current amount of the asset, there is a gain. But when the current amount of the asset is higher than the sales proceeds, there is a loss. And either the gain or the loss will be taken to the profit or loss account. Please take note of that. Whether it's a loss or it's a gain, you take it to where the statement of profit or loss is as simple as that. So this is everything that that we need to know under investment property. Now quickly let's go to the disclosure, because the disclosure is also what is very, very important. I told us whenever we are looking at any standard, we look at the overview, we look at the recognition, we look at the measurement basis, and then we look at their disclosure. Very, very important. These are the 4 key things to look at whenever you are treating any standard. So what are the disclosure requirements? Number 1, you must be able to tell us whether you use the fair value or the cost model in your subsequent measurement. You must be able to tell us. That's the key thing that you must disclose, is during your subsequent measurement, you use the fair value or you use the cost model to evaluate. Now, if you are using the fair value, it is important that you reconcile all the changes in the carrying amount. Reconcile the changes in the carrying amount. In other words, if you have capital appreciation, in other words, if you have the changes to be in incremental, that is, the changes increase the value of the asset, you have to tell us, you have to state it. If you reduce the value of the asset, you have to tell us and how you treat it. And then the method and assumption that you use to determine the fair value, you also have to state it. If it is I just checked GG, and this is what they told me on GG. They said they are selling the land, the land in my area now at 500,000. You need to tell us. Or you will say, okay, I just went to ask landlord around where my building and my land is, and then they told me that this is the amount that they are selling it. You have to tell us. And if you are using the cost model, you should know that the cost model only applies to building. You can't use the cost model for land. That is very, very important. Please take note of that. You can't use the cost model for land. You can only use it for the building. And if you're using a cost model for subsequent measure, you have to tell us the depreciation method that you use as well as the rate. If you're using the straight line method, you let us know. If you are using the reducing balance basis method, you have to tell us. Very, very important. So that is practically everything about IAS 40. It's a very simple standard, but I tell the truth, question can come in that will be trickish and you'll be able to handle it. And that's why all I have said so far, summarily, let me just summarize in 1 minute. I've told you the definition of an investment property. An investment property is any property that is being held any property that is being held for capital appreciation or for rental income. And this property include only land or building or both together. This land and building put together, either of the two put together, and that is the definition. That I told you, the person that can hold it is the owner or the lessee under the lease contract that is being treated under IFRS 16. When we get there, you understand it better. And I told you also that under the measurement, under the recognition criteria rather, that you have two major recognition criteria. The probability that the future economic benefit on the investment property is going to accrue to the owner or the entity. And then number two, the cost can be reliably measured. So those two things are very key for recognition under asset. Just in case you forget, and you're in an exam and they tell you what are the recognition criteria for, once they say it's an asset and you know it's tangible asset, just mention those two things that I have said. Or if it's an intangible asset under IAS 38, mention it. Very, very important. Probability of future economic benefit accrued to the entity, and then the cost can be reliably measured. And then we'll move to measurement basis. Under the measurement basis, we look at initial measurement, and we say it is the purchase price plus other directly attributable costs. It is usually your first year cost, the historical cost. That's what we call the historical cost of the asset, as it were. And then you have the subsequent measurement, and we are told you that subsequently you can measure an investment property using either the fair value model or the cost model. But it's always advisable that you use the fair value model. However, if you are using the cost model, you should know that it's not applicable to land. It's only applicable to building, because land does not and will never depreciate. Land will continue to appreciate. That is that for that. And then we move ahead to tell you that you can derecognize an asset, an investment property. And two criteria must be met for you to derecognize. Once you dispose, that's one. If you dispose, that is number one. You have to derecognize it as investment property. It's easy to become an investment property. When number two now, I told you that you can derecognize once the criteria is no longer met. That is no longer bringing in economic benefit and the cost cannot be reliably measured. You derecognize it. That is, you remove it as an investment property from your financial position. And then we went to disclosure and we talked about the fact that you have to disclose whether you use the fair value or the cost model in the reevaluation of your investment property, subsequent measurement of your investment property. And then you have to tell us, if you are using a fair value, how you reconcile the changes with the current amount, and then the methods and assumptions that were used to determine the fair value. And then if you are using a cost model, you need to tell us the type of depreciation method that you are using, as well as the rates that you apply. And then we said that the fair value of the property must also be fully disclosed. So that is basically everything about investment property. Now we go straight to the questions, practical questions, because we have discussed and discussed and discussed. So now let's look at this very scenarioic question. He said, I hope you can still see my screen. Please, before we go to the question, let me ask again, do you have any question? Are you okay? Is it flowing well? Give me an emoji, please, if you know it's flowing well. Okay. Apologies.
Hello, sir.
Yes, I can hear you. Please go ahead.
So I just want to ask a question.
Yes.
You said something concerning the investment property that it is only attributable to the plant, land and building. So in a scenario whereby an organization, maybe its primary cost of this business is different, I'm just trying to paint a scenario, but they have like full cars for rent, maybe for hire purchase and other, maybe for rent that will be any rental from it. So such property is not categorized as an investment property because you said investment property is only for land and buildings according to the standard. So I'm just trying to paint that scenario that maybe an organization now has another business that is not the ordinary course of the business of the organization, like having cars, full of cars for rentals.
Let
So
me explain
such
it.
property,
Let me explain it to you now. Now, such a business that you are talking about, you said they have cars and they are using it for rent. Let's assume that's what they do. That alone does not make that item an investment property. Why? Because they are trading it. In other words, it is their business. It's what they are doing. They are trading it. And then it means that they are earning income from it on a daily basis. And once it is like that, that item will be referred to as an inventory to the entity. Please take note of that. It is no longer an investment property. For you to call it an investment property, it means that you are holding it for rentals or for capital appreciation, and it is for more than 1 year. For instance, rent from a building is usually 1 year and above. That's what we know. 1 year and above. That is why we say rental income. If it's not 1 year and above, it is not an investment property. And then let me mirror it down again. Investment property only deals with land and building. No other item is considered. Please take note of that according to the standard. Thank God when you are asking your question, you said according to the standard. So I'm telling you now, according to the standard, only land and building or a part of a building that is being held for capital appreciation for rental purposes that can be classified, recognized, and utilized and carried as an investment property. Thank you so much. I hope you are clear, Olafe.
okay, thank you, sir.
All right. Moses, you raised your hand. Go ahead.
Yes, sir. Sorry, sir. Thank you very much. I want you to still help us to buttress on concerning that investment property that you say it is only based on land or building or both. Like some companies, maybe they use this trading in treasury bill. No, treasury bill can be invest in it, like all this kind of treasury bill, like millions that they invest on it with the purpose of some interest on it. Maybe if we have something like that in the scenario, in the examination scenario, can we ignore it as investment property? Maybe it just is part of the questions, like treasury bill and other things that is more than a year as investment. Can we ignore
Number one, treasury bill is a financial instrument, and treasury bill only trade for 90 days, so less than 1 year. So it has by that it has disqualified that item is already disqualified and cannot be classified as an investment property. Now, treasury bill and all those financial instruments, they cannot be classified as an investment property. Very, very important. Don't bother yourself and don't stress yourself too much. Investment property deals with the property of land or building or both. Land or building or both. Please. No other item is considered. Is that taken?
Thank you.
All right.
Thank you, sir.
All right, my brother. So let's look at this question, practical question, example 1. A company owns a building rented to tenant and also use one floor for admin purposes. I have mentioned this. You know the answer. What's the answer? The rented portion is an investment property, whereas the admin portion, that is known as owners occupied, that is accounted for under AS 16. Split the assets unless the portion cannot be sold or leased separately. So all of these are there as a question is very simple and direct. All of these, you don't need much Turinchi and grammars. Example 2, a company B holds an office block as an investment property. At the year end, the fair value increased from 50 million to 60 million. What do you do? Very simple. Debit investment property with a 10 million increase, credit fair value gain 100 million. Simple as ABC. So briefly, I want us to look at this question 1. Very, very thorough. Can you see my screen? Okay, thank you. Now let's look at let's look at this question. XYZ Limited owns a building that is currently leased out to tenants to earn rental income. The building was purchased for 1.2 million 3 years ago. The company uses the building neither for production nor for administrative purposes, nor is it being held for, say, an ordinary course of business. A. According to IAS 40, how should XYZ Limited classify this property? When should XYZ Limited recognize this property as investment property? The answer here. I modeled the answer there. A. IAS 40 defines property as property, land, or building. You know all the answer there. So rather than for use in production of goods and services or administrative purposes, since XYZ is leasing the building to tenants to earn rental income, this property qualifies as an investment property. Let me explain that. That is well explained. Or I should explain it. I'm sure you understand it. Let's just go ahead. B part. IAS 40 requires that an investment property should be recognized as an asset when and only when it is probable that future economic benefit will flow to the entity from the property, and the cost of the property can be reliably measured. So all of these I just modeled this answer because some of you, the way you are answering your questions, when I ask questions, is not well professional, and that alone can make you to lose your mark when you are in your exam hall. So this is how to answer this kind of a question. That's why I just put it here and for us to see it. Very cheap a question. If you read it now, somebody will say, this question is very difficult. What should I write? But everything I have explained so far is what you will put down as your answer. They say, according to IAS 40, how should this company classify the property? You state the definition of investment property, and then you refer the examiner to the question they said. They said, according to the company, they said they are not using it for administrative purpose. They are only holding it, and they are not holding it in ordinary course of business. Therefore, with this, it qualifies as an investment property. So also we have the B part, which says, when should XYZ Limited recognize the property as an investment property? It should recognize it if the criteria are met. And I told you probability is one, and then the second one is the cost measurement, the reliability of being able to measure the cost accurately. So it's as simple as that. So that alone, I think, will help you to build up. Let's also look at another question, and then we shut down tonight. Question 2, very, very. This one is question 2. I wanted us to. Okay, thank you. So this is question 2. At the time of purchase, XYZ Limited pay 1.2 for the building, and the relevant transaction cost were 50,000. What amount should XYZ recognize as the initial cost of the asset? Can anybody try? The initial cost will now be what?
1,250,000.
Thank you so much.
1,250,000.
Thank you so much. So that is that one. Let's look at another question. All of these questions, they are very simple a question. There's nothing difficult there. Once you see them, you can deal with them any day, anytime. If you have the material, the questions are enormous to guide you and to make you see where. Now, I want us to look at this question 7 together. Question 7. Okay, now let's look at question 7 together, because I want every one of us to do it under 1 minute, which is possible. Express Limited purchased an investment property for 2 million on 1st of January. Transaction costs were 100,000. On the 1st of December, the fair value was assessed to be 2.2 million. On 31st December, the fair value dropped to 1.9 million. The SYZ uses the fair value model. Calculate the current amount as at 31st December 2021 and the gain or loss to be recognized. Can you quickly do this, please? It's not difficult. Can we quickly do it? If you just know it, just tell me the answer. Are we together?
I cannot see your screen, sir.
Let me try, sir.
Yes, the
As
question is not clear.
at the December 2021, the fair value, because the initial cost with the directly attributable cost was 2.1 million.
Yes.
Then, as of the 1st December 2021, the fair value now is 2.2. That means there is an increment of $100,000. Then, as of December 2022, the fair value dropped to I can't see the okay. The fair value dropped to 1.9 million. That means 2.2 minus 1.9 million. That is difference of 300 loss. So as at that December 2022. So the balance, the carrying amount as at December 2022 will be 1.9 million.
Okay, thank you. Any other person want to try?
If I want to continue from where he stopped,
Don't
the
continue. Start your
300,
own.
I just want to add the one he didn't add because of time.
Okay, go ahead.
The 300, which is the impairment, 100,000 will be charged to revaluation surplus because the asset had been upward reviewed. I've had an upward reviewed previously, so 100,000 will be charged to revaluation surplus, and remaining 200,000 will be charged to P&L.
Okay, thank you. You have all tried. So quickly, let me just round it up. They have said the answer.
Hello, sir.
Okay.
Okay, all right. I just want to try my own, sir.
Just hold on first. Hold on.
Yeah.
I don't know why this thing is timing me. Say 4 minutes remaining. So I want to give an answer to this, and then we create a link because we are continuing. We create a link. We must do IFRS 5 tonight. So now look at this. The current amount at 31st December 2021, they said we should determine it. The current amount that's at 31st December 2021 will be 2.2 million. Why? Because there is a fair value increase from 2 million as at 1st January, as at 31st December is now 2.2 million. So we have 2.2 million will be the current amount of the asset. So the accounting treatment will now be you debit the 200,000 to asset, and then you credit what is it called OCI with 200,000. The gain, that is the revaluation gain, you credit OCI. Please take note of that. Very, very important. You credit OCI. Now we're now told that the second year, which is 2022 now.
I think the gain is 100, sir. Sir, I think the gain is 100 in 2021. 100,000 instead of 200.
Yes, it's 100.
How is it 100?
Yes, because of the cost.
Because the cost attributed.
Initial cost is 2.1 million. And
yes, plus the cost.
Fair value at the year one is 200. So that's
Okay.
100.
Yes, you are right. Sorry, I didn't even see that one. I was rushing because of time. You are actually correct. Thank you. So I didn't confuse you. I thought I would be able to confuse you. Okay. So that so that is that for that. So now, since you understand it, let's just go ahead, because I know that My students, they are not dull. They are very, very, they are doing well. So these are the answers. Very, very simple. At the end of year 2. Okay, that's that for that. So I think just like what they have explained, that's what we have here. You see, we now have 200,000 as loss, recognizing the profit or loss accounting current amount is 1.9 million. It's as simple as that. I've given you the solution. It's slightly written on the screen now. You can see it there. We have less than a minute. That's why I'm rushing now. Please, once you have the material, go through the questions. Very, very important. Don't shut down. I'm creating a link now, and we are looking at IFRS 5. I've sure I've been able to pass knowledge across to you tonight, and you can deal with IAS 40 any day, anytime, anywhere. Thank you so much for listening. I'm sure you are fine, right? Can I go?